Hello and welcome to Clearcut's latest biannual portfolio update. I'm pleased to introduce Greg Colley, our investment strategist from FE Investments, who will walk through with us recent market movements, our forward outlook and the updates we've made across the portfolios to ensure they remain balanced and aligned with your goals. FE conduct these reviews twice a year as a minimum to make adjustments to the portfolios that address changing market conditions while supporting your investment objectives. So let's dive in and hear Greg's insights on the latest changes and what they mean for your portfolio.
Hello, and welcome to this FE Investments presentation in association with Clearcut. My name is Greg Colley, I'm the investment strategist here at FE Investments, and I'll be running you through the presentation today. First of all, I must start off by reminding you that this is not a financial promotion and is not intended as a recommendation to buy or sell any particular asset class, security or strategy. So for today's agenda, we'll start off by talking about the markets and the economy, and that should provide a bit of context around the portfolio changes we're making, which we'll discuss in the second part of the presentation. So onto the markets update then, and looking first at the market performance so far in 2024. It's been extremely positive across the board in 2024 for markets, and you can see that with a chart on the left there. Most asset classes or equity regions have been generating some positive returns. Now, the hopes for a number of interest rate cuts across the year have certainly helped to boost markets, and that was more of a factor through the first half of the year, as you can see. That's when we started to see inflation fall back towards the target rates across many Western and developed economies. And so that led to better returns for equity markets, because as the cost of borrowing money becomes cheaper, that can generally lead to a little bit more expenditure in the economy and therefore more money circulating economies. Now, through the second half of the year, we saw equity markets flatline a little bit more so as the fears of a recession or an economic slowdown began to heighten a bit due to various bits of economic data which came through. And so equities were a bit more flat through the second half of the year, albeit still generating some returns. But we saw fixed income start to pick up, and that's what we like to see, the inverse correlation between fixed income and equities. So onto inflation, which has been falling back towards the target rate so far in 2024, or actually falling past the target rate, which is 2%. In the UK and in Europe, we're now at 1.7%, and the US is now at 2.4%. So with that normalization in that inflation trend, there's a lot more positive sentiments in the economy. Core inflation has still been a bit sticky in the US and in the UK as well. So core inflation strips out the food and energy inflation into that reading, because these components can be a bit more volatile. So some say it can be a truer reflection of the state of goods inflation or services inflation in the economy. One area we could keep an eye on is energy, albeit that is stripped out of that core reading. But due to the Middle East conflict, that's causing a bit of volatility in the price of oil and gas. And so as tensions escalate over there, sometimes the price of these commodities go up, but as things cool off, then the price is going down. So if we were to unfortunately see a big escalation in the conflict in the Middle East, then we could see energy prices start to rise quite heavily again. Economic growth is also rebounding in Europe, which is a very positive story. We've seen both the UK and the Eurozone really struggle with generating good levels of GDP growth, and you can see that with the chart on the left there. That's looking at the UK annual GDP growth rate. And the UK and Europe have both been suffering similar economic shocks over recent years, obviously the pandemic and also the Russian invasion as well. But we're starting to see these shocks pass through the economy now. They're not impacting us quite as much. And you can see that with the bounce back of that GDP growth figure. In the US, the picture has been different because they haven't been quite as subject to, I say, the shocks that we experienced in the UK and Europe. Obviously the pandemic affected them as well. But the Russian invasion obviously wasn't quite as impactful to the US as it was for us. And they've also been implementing different government policies. They've been spending a lot of money on their economy, which has allowed them to continue to generate strong levels of activity and support the economy really through what has been a challenging number of years. But enough about inflation. We've been talking about it for a long time now. I'm sure you've been reading and seeing lots about it in the newspapers or wherever you get your news from. So, what should we focus on now? Well, the answer is probably interest rates. And people are now questioning how many we're going to be seeing and how quickly we'll see these interest rates come down. So in terms of interest rate cuts, low inflation and low economic growth are really the ideal conditions for these interest rate cuts. Because as we see interest rate cuts, they can spark economic activity again, which obviously increases GDP growth, but can also mean that inflation sometimes picks up a bit again as people are spending a bit more money and generating more economic activity. So UK and Europe have both low inflation and a low economic growth, which could mean we see the Bank of England and the European Central Bank implement more rate cuts or more rate cuts in a faster fashion. In the US, on the other hand, as we've just seen, economic growth is still quite strong there. And so cutting rates too soon could generate a level of GDP growth which reignites inflation and then could mean the Federal Reserve, the American Central Bank, have to go back to the drawing board in terms of where they are with interest rates. And so in terms of the market expectations at the moment, they're expecting the Bank of England to enact a quarter point cut in both November and December, bringing the current rate down a total of 0.5% by the end of the year. As I said, the risk of cutting interest rates is if you go too soon, you can reignite inflation, but the benefits are that lower interest rates can cause better market performance and general economic performance as well. So in terms of our outlook from here, we really think there are three scenarios to consider. Number one would be the soft landing. So as I said, this is where the economy slows down without entering a recession. And this is our base case, so our most likely scenario. Scenario number two would be robust growth, so a combination of stubborn economic growth and high inflation. We consider this less likely, but this is the biggest threat to portfolio performance, as the combination of stubborn economic growth and high inflation would probably challenge both equities and bonds at the same time. And so you'd see both components of the portfolios potentially losing value, hence it is the biggest threat. And the third scenario is a recession. I'm sure you'll know what a recession is. 2 consecutive quarters of negative GDP growth. And again, we consider this less likely from where we are at the moment. The data definitely isn't pointing towards it quite as much anymore. But in this scenario, the portfolios would actually be relatively well protected, given that government bonds protect well in recessionary periods. So yes, it may challenge equities, but the government bond portion of the portfolios should hold up well to protect capital value. So onto the portfolio changes then, and keep in mind what we've discussed in that first section. So portfolio 2B, the lowest risk portfolio, we are reducing gilts a little bit. We think it could be volatile post-budget discussions. And we've actually already seen this as well. We've seen gilt yields rise on the back of the budget announcement. And as gilt yields rise, the gilt values fall. So that immediately has looked to pay off. And we've achieved that by making a bit of a fund switch there. We've moved from Vanguard to the Royal London Fund. The Royal London Fund, which has also trimmed the interest rate risk. We've redistributed some of that gilt allocation into an absolute return fund, and that helps to manage the portfolio risk. Absolute return funds generally aim to generate a consistent level of return and aim to chug along in quite a flat line, no matter what the market conditions are. So they can be a bit more expensive, but they do provide a strong level of protection against most market conditions. And then that switch has freed up some volatility in the portfolios, which means we can move some of the UK equity allocation for the US. We've been running a bit of a higher weight to UK equities in the portfolio. So you can see we've cut around 3% of that allocation and the US equity has seen a good portion of that. So to conclude then, there are many reasons to be positive. UK economic growth is picking up, inflation is below the target rate of 2%, and this could prompt interest rate cuts, which stimulate the economy and generate more activity. In terms of investment performance, it's been strong so far year to date, and the outlook suggests this could continue if we do see this soft landing scenario, so we don't see a recession, for example. And these interest rate cuts can also boost bond values from where we are at the moment. Bonds have been really challenged with economic conditions over the past 2 years, but it looks like conditions are starting to ease up for them from here. That does conclude. Thank you very much for taking the time to listen. If you do have any questions, please just get in touch with a financial advisor and they can pass them over to us. But in the meantime, take care and thank you very much.